Today's market call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. With Fidelity Trader Plus, you can customize your preferred tools and charts and tap into crucial data across all your devices. So I can save an order on my desktop at home, get a mobile alert here at the studio, and complete the trade in the Fidelity app without starting over. Try it for yourself at fidelity.com/Trader Plus. Hey, November 10th, 11 a.m. on the East Coast. As amazing as Fidelity Trader Plus is, that's how awful the football giants of New York are. We were just talking about it prior to the show. Once again, losing a game that was almost statistically impossible to do, but that's how. Listen, but you know what? You think about it, maybe losing is winning for the Giants. What do I know? Dan, how are you?
Well, by the way, you might see Colts, Eagles, Super Bowl. Who knows, right? You'd have your main man, Indiana Jones, playing against what was his main man, Saquon Barkley. I'm just saying, like, that would be kind of crazy. And then
it's not out of the realm of possibility. I will say that.
Jets. I mean, the Jets win, Giants lose on a day like that. But whatever. Let's move on, guys.
It's meaningless in the NFL. Listen, you either want to be really poor or really good. If you're in the middle, you're nowhere. Like the market, by the way.
Well, it's funny. Some of the things that are going on today. Okay, so Guy, whatever the announcement was that you have this group of Dems that are cleaving off from this kind of, from the majority, if you will, of that caucus to basically put an end to this shutdown. The fact that headline, which still needs to go to the House, I think the House is a bit more emboldened about some of the issues that they want, at least from the Democratic side, that we would have a 1.5% gap open. Now, we had that rally late on, actually all afternoon on Friday.
Mm-hmm.
Some stuff is obviously leaking out there. I just didn't think a lot of the weakness that we had last week was about a continued shutdown. I mean, if anything, we've been talking about this for weeks, that we were surprised that the market wasn't pricing anything in for a shutdown. So to get the open here that we've gotten today, it is head scratching, but we're going to talk about some of these sectors. I mean, this is all a bounce on the AI trade. I mean, that's all it is. And I don't know what that has to do with a shutdown, Guy.
So I'm going to use a term, and you're going to say a clever retort when I say it, because that's the way, because you're in my head, I'm in your head.
Yeah.
But given what you just said, I guess the optimist would say, but for those headlines, the market would have been a lot higher. In other words, if we never had the shutdown, maybe the market would have been higher in the first place. Go ahead.
Do you know what a but for is, Guy?
Exactly. See, that's
sitting. It's for
but
sitting.
in other words, but I guess what I'm saying, I don't adhere to this, but the market never sold off on the back of the shutdown. It's higher in the aftermath of, and I guess people would say, well, if we never got those headlines, we would have been significantly higher in the first place. You can't do the counterfactual, but that's sort of the bull case.
All right, so let's just take a little whiz around the world of markets here. I'm looking at a small cap index that would be the Russell 2000 that gapped up, I think, 1.5%. It's only up 0.5% right now. The IWM, the ETF that tracks it, is only up 38 basis points. So that feels like it's about to go down on the day. We don't have yields moving. It is Veterans Day. Shout out to all the vets
Tomorrow's
out there.
Veterans Day.
My dad retired. Is it tomorrow?
Isn't it November 11th? Isn't the 11th hour of the 11th day of the 11th month?
So we do see yields moving, but they're not moving. That's my point, Guy. Okay,
no, I understand.
They're not moving.
I'm not looking to break. Yes.
Can I still
being
give
a student of history? Yes.
Can I still give retired lieutenant colonel from the Army?
Of course you can.
That is my dad. A shout out. I feel like some of the vets of that era don't get their due. He is 83 years old and gave a very nice portion of his life to serve, and also into the reserves for decades or so.
It was originally called, in case anybody cares, Armistice Day.
Oh yeah.
It was a post-World War I thing. Anyway, we'll talk about that tomorrow on Vet.
Yeah. Well, we will give a shout out to our vets today and tomorrow. You know what also November 11th is, Guy? It's a day in China that they speak often about all year long. They wait for. It's called Singles Day.
Yeah.
Singles Day, 11/11, and it's a lucky sort of thing. Um, Torsten Slok had a note. I just think this is really important, actually, because, and it will become more important over let's say, the next 10 years, about the demographics in China. I know this is a total aside. Starting in 2022 was basically the first year where China has had more deaths per year than babies born. And when you see this sort of shift over the course of, let's say, history, about a once sort of look at these guys, Johnny on the spot. We talk about demographics and what it means. It means that you have a workforce that is getting smaller. You have an older generation that takes more resources, right, as healthcare costs and a whole host of sorts of things. And in a country like China, a lot, this is just, I think, part of their culture. You have the younger generation taking care of the older generation. So when you have this sort of stress on the workforce, it really does mean that you will have a slowing economy. And for the last 10 years, we've seen China's GDP go from double digits, or maybe that's the last 15 years or so, to mid-single digits. And, when you talk about this adversary of ours, when you talk about the developed world, our demographics in these sorts of terms are the least bad. Germany,
Yeah.
these sorts of things.
Well, what's amazing about birth rate, and I'm not necessarily a student of history that way, but you go back to sort of 1960, and I think there were almost 3.5 births per woman in the United States in 1960. That number today, I think, is down to about 1.6. So we have a deteriorating birth rate around, well, at least in the developed nations, in a pretty meaningful way. But your point is well taken in terms of what it means historically for economies.
Yeah. And again, we talk about this I guess when we think about the Chinese, they're looking 50, 100 years out when we're talking about a trade war, when we're talking about Belt and Road and a whole host of other initiatives that are very important to them. Maybe they are, like not nearly as strong looking out, let's call it 50 years. And again, this is not, anything that's so relevant to what we do here and now. I just saw that chart this morning. I thought it was interesting. Taking that whiz around the world here, at least around the market. What do you see, Guy? I mean, a sea of green, and we're going to talk about a bunch of these names.
Yeah, so let's play the game.
A lot of red. I also see a lot of red.
Banks up. Okay, so just the things I'm looking at, and we can dissect it. By the way, I buried the lead. Carter Worth will be joining us, I believe, in a few minutes as well. So I'm sorry about that. But obviously, there's been a rebound in gold. We've talked about that. I think we've done a nice job in terms of gold and silver, and the miners are participating. But the two things that stick out to me on top of that are is weakness in banks, which we can look at, and the weakness in home builders, which we can also look at.
Yeah, and let's pull up the gold chart for a second, because when it reached a bit of a fever pitch when we broke above 4,000, right, and we almost had like a 10% move and felt like in a sort of parabolic sort of way. Carter had a great call on that to kind of take profits, and then it kind of checked back to that 4,000 level, and you see this bounce here. What's also interesting to me, Guy, is that Bitcoin is not rallying. And Bitcoin has, and you say, why do you guys talk about Bitcoin? Well, we just like to bring it up once a day. It is a $2 trillion asset class. It does to some degree reflect a certain amount of risk taking, or at least risk appetite here. But this thing, man, and I got a bunch of questions about these treasury stocks over the weekend by some smart friends who are not paying that close attention to how those trades are constructed. Jim Chanos, our good friend of the pod, but also personal, he took off this trade. He was basically shorting MicroStrategy and buying Bitcoin, and he was trying to get that spread to complex. Why is this important to you, the way you look at Bitcoin and then these treasury trades?
I think you bring up Bitcoin, you're right. I mean, it has bounced a little. I think we got down about 98,000 or so at its trough last week or whenever. It's trading about 105,000 now, but I think your point is well taken. The rallies are feeble, in a word, and there is still a concern, at least I still have a concern, that Bitcoin, to me, is the ultimate risk on, risk off asset, and has been trading like risk is coming off over the last, forget about a couple of weeks. I mean, this has been going on for a while now. Dan, if you look, I think Bitcoin made its all-time high in early October. Is that right? Like October 7th? Yeah. We're sitting here, as we mentioned, November 10th, and it's been basically significantly lower ever since then. You've had a couple bounces along the way, but nothing to really write home about. And my concern, if there is a concern, you go back and look if you go back all the way to January when we were basically up against that sort of 102-ish level, 103. So past resistance becomes support, and we're basically right at it now. I think if we were to break and close sort of below 98,000, then we're going to start talking about the average price of the Bitcoin holdings at Strategy, formerly MicroStrategy. I think their average price is about 74,000, give or take. And it's going to be interesting to see if and when we get to that level, what happens to obviously Strategy, the stock, Bitcoin, the asset, but the broader market as well. So that's obviously something I continue to watch.
Yeah, and I guess the point there, just to keep people up on what's going on here. So Michael Saylor has been a huge proponent of companies like his going back for maybe a little longer years, replacing, let's say, assets on their balance sheet, treasuries, whether it's cash, that sort of thing, with Bitcoin. He made a very cogent case. It worked out very well for a while. For some reason, the NAV of this company traded at a big premium, right, to it was almost as high as 3x or something like that. I think Jim said in his tweet it came down
got ridiculous at one point. Yeah,
and now it's collapsed to 1.25. And I guess the point here is that MicroStrategy, their market cap is 68 billion. They're holding 641,000 Bitcoins at, their average price of, let's say, 74, 75 is about 50 billion, I think, if I'm just doing that math or what I've read. So at some point that could be a really interesting thing. And the other thing is that Michael Saylor got a lot of other companies to do this same trade. And a lot of them probably, did it at much higher levels. And then what we've seen over the last, call it, few months or so, companies that are basically going public like SPACs just to buy Bitcoin. There's no underlying, you know what I mean? Like, so again, looks a little silly. Let's talk about some of those sectors that are red before we get to tech. I mean, you just mentioned financials, underperforming banks in particular. We're also seeing, let's say, an Apollo that had a great quarter last week, KKR, those sorts of names are all down. Retail sticks out to me like a sore thumb. You mentioned home builders, but home builders in HD, let's just look in the terms of that. Thoughts on, let's say, retail and banks here?
I think there's a combination of things going on here. I think the employment picture is murky at best. Obviously, I think some of this government shutdown clearly has impacted some people. We're talking about the aftermath now, but I think there's some lag effect there as well. I think interest rates are part of this as well. And I think just the stress on the consumer in terms of delinquency rates is out there. And these all things that we've been talking about. And, Home Depot is one of those stocks that if the consumer and the housing market was as robust as a lot of these pundits speak about, then Home Depot on this tape should be trading at an all-time high. And we're obviously nowhere close to that. So, that's something I watch as well. At some point, Home Depot, I think, is going to be interesting on a technical level, on a valuation level. But at 364, I don't think we're there yet. And quite frankly, Dan, we're closer to a 52-week low now than we are to a 52-week high, which I also think is interesting. Huge support if you want to play the game. Go back to March of this year when we're trading about 350 or so. You go back to sort of June-ish, 350 or so. That's your support level. But you can start making an argument that you have a bit of a double top here going back from December of last year and the recent high that we saw in September of this year.
Yes, and then here's a retail stock that's trading at its 52-week highs, and this is look at TJX, and this is
always a monster.
It is literally traded like a monster here. It's banged around between 139 and 145 over the last few weeks or so. But you look at this thing, you still see a series of higher lows and higher highs. And, you've been talking about some of these other discounters like Dollar Tree and Dollar Gen. When you think about these value sort of names, an environment like we've been in where, we've had, a million, government workers that have been furloughed or fired. We've had the fear of these ACA premiums going higher, and you're seeing lots of sort of consumer sentiment readings suggesting that folks are getting a bit more cautious. You see the Kroger and some of these other names that have been weak because of these SNAP benefits that did not go out on the 1st of November. And, you say to yourself, like, there's some stuff that's going on in consumer land, and I'm not so sure that a quick sort of resolution in the next, let's call it a few days or a week to the government shutdown fixes a lot of that, guy.
Yeah, I agree with that. I think the consumer's in a place now where, thank God this seems like there's going to be a resolution and we'll get back to some semblance of normalcy. But I think the damage was done, in my opinion, long before the government shut down. I think this just sort of sped things up. But in terms of speeding things up, we should speed things up and get to our, should I say main man? That's a term you use all the time, but I'll use it because why not?
Carter
that would
hit.
be the great Carter Braxton Worth, who has been sitting patiently watching.
Wow.
Oh, Carter. Look at that.
Man, how are you? Happy Monday.
You've heard some of the things that we've just been pontificating about. Quickly before we get into some of your work, not that anybody cares about the Dow, but the reversal we've seen over the last hour or so in the Dow Jones, which got up to, I think, 47,300. We lost 300 points in the Dow. The S&P's given a little bit back. Thoughts on just the broader market, the importance of today if we hold or if we fail?
Yeah, I mean, well, a couple of things to your point. It's not all that the headlines or all the green would appear, in the sense that it's not all green, right? We know there are more decliners in the Dow today than there are advancers. There are more decliners in the S&P than there are advancers. And so a mixed bag, to say the least. And it's always and ever thus those huge star players that are carrying the team. And that's the nature of this particular market. It's often the nature of, and Guy, certainly as a sports person, that it doesn't take but one, Gretzky or one Babe Ruth or one LeBron James or Michael Jordan to carry the day. This is the nature of having one or two people being so dominant that they can even pull along others and make others less important. And so just thinking about the concentration, which is always the same, it's not the tech sector at 35%, which it is now. It's actually closer to 50 because they took Google out, right? And they took Netflix out, and they took Amazon out, and they took Meta out, and they put those, Amazon's, of course, over in consumer discretion. It's a store. So they said, we'll put that in consumer discretion. And Meta is communications, and Netflix is communications, and Google. So if you put those four alone, which are about 12% of the S&P, back into the tech sector, which they were, tech is at 50%. Mm-hmm. It's one and only one thing that matters, and unless and until you see something go wrong in paradise, it's something that keeps the market going. But very sloppy day, to be sure.
All right, so Carter, sloppy day, but it felt like an absolute panic on the opening. I just want to pull up SanDisk, comes out SNDK. Okay, so this is one that we've talked about. I mean, like, listen, I get crazy about like certain things. I literally can't stand this sort of euphoria in the stock market for one reason, that we know that it has to correct at some point. We also know that this is a retail thing. I mean, if you are an institutional sort, and don't take this the wrong way, people, but if you are an institution and you are buying this stock up here, you should be neutered, okay? Because any amount of stock that you're buying, you're taking a longer term view for the most part, right? And you're saying that from these levels, you see this stock working because the company makes this product and this is who they compete with, and they have this advantage, and they're about to get this contract and everything like that. But this thing gapped up, Carter, 10%. After raging yesterday. Like, do a 3-day chart here. So just help me with this. And I know that was a little Jerry Maguire. Help me.
Yeah, it's just one of that's the momentum's a powerful force, and it goes the way down too. As we know, look at something like a CarMax, and you see certain stocks that ultimately slip below the surface without a trace, and they go bankrupt. And on the way down, they gap and drop and gap and drop and gap, and people can't believe it. Surely it's cheap. I'll take a shot. And you can get bounces, but they end up going away. And we're seeing this in so many stocks. This is WDC, right? This is MU and so forth. A lot of assumptions need to be made in order, and this is to your point, to be committing new capital here. Assumptions that are unknowable, right? If you probably pulled up a price target on Wall Street, it's probably lower than the stock is trading now. Not that Wall Street's price targets are sort of gospel, but those are people who are paid, paid and highly educated to try to get the answer right at a professional level. And if collectively a group like that thinks the stock is worth less in the future than it is now, what does that say?
You're going to be fascinated, Carter. Okay, Guy, I want your guess too. So again, the stock is up 400%. So let's just do this. Let's go back to SanDisk. Stock is up 400% since the first day of September. Okay, so we're talking a little more.
Month.
All right. So 2 months. So
you're right. Sorry, my bad.
So there are 21 analysts who cover this on Wall Street. Okay. Take a guess. So the stock's at 260. Carter, you first. Take a guess what the average price target among 21 analysts is.
Yeah, invariably it's lower. It's kind of why I brought the point.
How much lower?
I bet you $10 to $15 lower than the current.
Okay, I didn't want to tee you guys up.
I'm gonna say 185.
Okay, well, it's just come up dramatically. You know what I mean? They've been chased. It's $250, right? There's 14 analysts who rate the stock a buy, 5 holds, 2 sells. And so to your point, Carter, these folks are just chasing their tails, but, the investors are just chasing the whole thing up. So, Guy, come on, help me out here. He just mentioned Micron. He just, we're talking about WDC. So it's memory and it's storage. And for whatever reason, folks that were really all in on this AI trade, they said, this is the next thing.
And it might be the next thing. But what we have learned, I think, especially the 3 names we just mentioned, SanDisk, well, at least the 2, SanDisk and Micron, they're highly cyclical, highly commoditized companies that are trading like they're no longer that. And I don't think the world has changed that much. Now, what's interesting, our friend Jeff Richards, real quick before we get to Carter's Worth, I don't know if we have this note or this tweet he put out, but he was talking about how market breadth is not as important now, and people like Guy Adami, he didn't mention my name, that are getting sort of getting breathless talking about market breadth. They're sort of missing the point because, quite frankly, the world has changed a little bit here, and this is a market breadth chart. You can pull up the Jeff Richards tweet. Anyway, the point is, a lot of people are making the point that it is in fact different this time. I'm not there yet, Dan.
Well, yeah, I mean, so look at the underperformance we've just had of late, of a bunch of these names. Look at what happened when investors, finally said, okay, well, you know what, maybe things have gotten a bit euphoric. We talked about this last week. There was a bubble in calling a bubble in this sort of thing. Well, when bubbles pop, even little ones in a short-term basis that are just, sentiment, which is not specifically, to one stock or whatever. And obviously there's a bubble in some of these names that we just mentioned. But when the concentration goes the other way, you see what happens. And so even today is a good example. We're seeing a lot of underperformance from a lot of different sectors in the market. Yet the market's still up handily based on the performance of these concentrated names. So I'll just leave it at that. Carter Braxton Worth, CBW. What do you got for us today? What are you focused on? I know you had a great note out on Friday. Talk to us.
Yeah, looking at just some of this is it's an extraordinary period, both on the way down and the way up. I mean, if you think about it, there are only a handful, or maybe 15 instances where the S&P has dropped from an all-time high more than 20%. That happened, news-related, news-induced, but it happened because of tariffs. So the tariff-related news. And so in this year alone, just think how epic that is to have a 20% plus sell-off, and then to not only have that, but to dust that off and to get back on up. I mean, it's the Rocky Balboa theme that, my God, you can't keep the thing down. It gets up and it goes on to make these shocking new highs. So if you just look at that period from the April 7th low to 7 months later, the November 7th, which is last week, this is an extraordinary instance where we've gone 7 months without so much as a 5% pullback, dip, correction, decline, drop, drawdown, you choose the word. But what is the rarity of that? And some of this effort was trying to put that in context. If you go back to the beginning, let's look at the first pages quickly again. You'll see that 5% plus sell-offs occur every 2 to 3 months. Right? That's normal. I mean, think about it, your own stocks that you buy and say, oh my gosh, we're down 5. That's routing error. It's nothing. But put this in the context, you'll see in the 2 tables that follow how rare this is. So in the past 50 years, this is now 148 sessions without so much as a 5% pullback. And now, is that the longest? Not at all. You can see there others which went almost twice as long, and one could say, yeah, and that's what's coming now for those who are bearish. Wait till you see. But what cuts the other way is, while this is the 15th most extreme, if you look at the next slide, in terms of magnitude, it's the second. So now it gets into, what is possible because think about it, you just forget that it's 7 months, let's go to 6. We're annualizing essentially at 100%, right? Or close to it. And markets don't do that. Or put it this way, when they do, what comes next is sometimes quite unhappy. And so this is let's look at the chart. We might have a chart of the whole thing, and I don't know, but I mean, here you have it. These are just minor little 2-3 day, 2-4 day, 3-4, 5-2 little nothings. And guess what? This was as the time of the report. We've ricocheted. We went a little bit lower on Friday. This was on Thursday, and then we're higher today with the gap and so forth. So the question is, where are we in that cycle? So just maybe we'll end with where we started. Let's go back to those two tables. So just put it in context, 7 full months, 148 sessions. We're moving every day higher in duration. You had another day here. So we're getting into going to be the top 10 of all time in the past 50 years anyway. And then in terms of magnitude, of course, we're pushing into what is a record.
Yeah, I look at this, and that's exactly what my eyes saw. Then you obviously had the chart that backed it up. But December 94 to February 96. So basically twice the amount of time in terms of duration as we are now. And we basically have had the same move, give or take a couple percentage points. And there's nothing natural about this, Dan. And as we've talked about, it's been driven by the same 8 to 10 names we seemingly talk about every day. And we talk about them because if you look at this chart, Dan, we have to talk about them.
Yeah, and I think it's interesting that we're using that point April 7th, and it makes total sense. That was the bottom of the terrorist induced sort of sell-off. And one of the things that I think is interesting, because that taco thing was coined back then. And if you want to go back to that chart that Carter highlighted, just showing these 2 to 3% down moves that lasted a couple days. I mean, in each one of those scenarios, I think there was like some announcement followed by, here's a framework, a trade framework with the EU. Here's something with, Mexico. Here's something with South Korea. Here's something with Japan. And I'm not saying like but like we sell off a little bit in front of those. They're from all-time highs. If you just look at that, or once we got through May, right? Like that sort of thing. And so there seems to be no shortage of headlines that they can just kind of get out there. And I'm not saying there's anything wrong with that whatsoever, because it seems like there was an overreaction, obviously, in March into April. And it seems like market participants, and we've been talking about this for weeks, they got their arms around worst case scenarios with tariffs. They got their arms around shutdown, or didn't care about it. They care about it today. There's a whole host of other things, weakening, labor market, a whole host of things. So, again, investors don't care. Carter, we really appreciate you coming here on the morning. We appreciate your fine work. You guys know where to find it. worthcharting.com. Go check it out. Thanks, Carter.
No, Carter's work is amazing. And those charts to me are fascinating, and you can't time. It's very hard to time, Dan, any of these things. But when timing is everything, you need a platform that can meet you where you are. With Fidelity Trader Plus, you can customize a chart or start a trade on your desktop setup at home and pull it up on your phone or laptop at work. Fidelity built their new advanced trading platform from the ground up with better connectivity and more powerful tools than ever before. You should definitely try the all-new Fidelity Trader Plus, the next generation of advanced trading from Fidelity. And I bring that up because, you can look at Carter's, that graph that we just said, or that chart, or whatever it is that you want to call it, and say, all right, history suggests we're on the precipice of something. You want to be prepared for these things.
Yeah, and I guess this goes back to what we were just saying, Guy. I mean, it just seems like whatever's been thrown at the stock market, and we've had no shortage of kind of challenging sort of economic data. And this is something that the Fed has, obviously, acknowledged. This is one of the reasons why we have this push and pull between what they may do in December. Let's go to the CME Fed Watch tool. I think a 25 basis point cut, prior to that last meeting that we had on October 29th was nearly a given, right? And now that's kind of come off a little bit. And the other question is like, when are we going to start getting some data one way or another? Like, you see that, and that's got to be what percentage is that? 62%. So that's kind of a low, I think, since October 29th. And there's a lot of Fed speak. I'm looking here. So on
Big
Tuesday,
Fed speak week. Yep.
yeah, you have Barr, whoever that is, but and then on Wednesday you have Williams, Waller, Moran, and Paulson. Okay, so we know who a lot of those folks are, and we know Moran is the choice of the administration as a Fed governor, and he's the one who dissented for a 50 basis point cut. The rest, we saw the minutes of the prior month, and it seems like there's a real big debate here. This push and pull between inflation, which is really stuck here, it seems like, in this kind of 3% range, and then a labor market that is weakening, but it's been hard to tell because of Doge and because of the shutdown, that sort of thing. So it'll be interesting to see when we start getting a catch up on that data, guy.
November 10th, a lot of Fed speak. In terms of where we are in the market, a lot of people are going to chase now with the last month and a half or so left in the year. The flip side of that coin is, there's just a lot of incongruities out there that suggest to me that, again, volatility is going to come raging back in a meaningful way. We saw it a couple times over the last couple of weeks, got back down to 18.5 now. I think we're setting up for another move higher in vol as well, Dan.
Yeah, one name, if we just want to look, we're not done with earnings yet. One name that really sticks out to me tonight after the close, guy, is CoreWeave. And the stock is down 40-some% from those highs, and maybe you could say, well, it's up more than 100% from its IPO price from late March. I'm just going to look real quickly here with the stock trading at like 104.5. If I look at the money straddle, I'm getting about $15, which, if you just do that math there, we're talking about what, 13 or 14% implied move, which to me, let me just kind of look and see what we've seen in the quarters. Okay, so you have about 13% move. Last quarter, the stock was down about 20% after its report, and the quarter before that is down 2.5%. I mean, I would expect some big move in here. And if we're going to start to see some sort of deceleration in growth among the cloud sort of businesses, the neo clouds should, in my opinion, show that before you're going to see from the major hyperscalers. This is a company that still loses a lot of money, and they've been raising debt to fund the expansion of their data centers, and they have $14.5 billion in debt. They have $1.1 billion in cash. Like I said, they're losing a lot of money. $51 billion market cap company, which seems absolutely insane to me. So this is the one I'm most focused on to hear what they have to say about their customers, their customer concentration, and growth rates.
Yep, and that move, if in fact it was to the downside, it would take us right back down to the September low, which I think was about, 89 or so. So the math actually, yeah, you can see it right there. The math actually makes a little bit, it's actually 85. So the math makes sense too, in terms of if you get that implied move, where the support potentially could be.
Yeah, another one, is interesting to me, guy, is Cisco. This is a name that kind of joined the party late, like the storage and like the memory. And I think people came around to the fact, oh, you need like switches and routers and all this sort of stuff in the data centers. Now, obviously, this has not, been off to the races and kind of parabolic, but I'm interested to see what they have to say for a stock that, is up 25%. The NASDAQ's up 20%. And towards the end of the week, I just want to go through a couple of these. AMAT, so this is a semi-equipment. You'd think that these guys are benefiting from this huge, and the stock has definitely, come around to appreciate that. They did have a disappointing quarter and guide 3 months ago. So this is one it'll be interesting to see after that massive move the stock has had from basically 159 up here to 233, from their post earnings to where it is right now. This is basically, not far from an all-time high, which we got in 2024. Do you think that this might be a decent read, especially on a day that we saw sales from Taiwan Semi, which is obviously a huge customer of AMAT's, but they saw the lowest monthly growth rate in October, I think in 18 months, is Taiwan Semi.
What I thought could happen here, and it's actually playing out, I thought it could, as we got closer to earnings, it would sort of do the slow grind and revisit the levels that we saw last summer. I think the all-time high was about, 245 or so. You can probably find it for me, but you see what I'm looking at. in terms of that part. It was even higher than that. So 255, 260.
Mm.
And I still think there's a chance that that happens. But if in fact you get there, it's probably going to happen on big volume. I think you got to pull the ripcord and then potentially look for a gap fill at some point if the market ever were to sell off. And that gap fill took place in late September of this year. So, or the gap at least took place in September of this year.
Yeah, and what's interesting is about that gap, all the way, like post earnings last time. I mean, when you have a company that resets expectations or disappoints the street, now you've got a lower bar as far as the numbers are concerned. But the way the stock is rallied, you have to say to yourself, expectations, in my opinion, are really high from a performance standpoint. All right, last one, Disney. Okay, so this might be a decent read, on a whole. Let's make that a 1 year, if you don't mind, let's go back a few years, and you're going to see this range, guy. But this might be a decent kind of read on discretionary spending. Look at this 80, like to the penny, going back to 23, right? And then you look at 125 ish as resistance. You see a couple gaps during this period over the last, call it, year and a half or so. This is a tough one, man. Sitting right on that 200-day. Thoughts?
So I was incorrect in my. I thought that Disney basically started to figure things out earlier this year, and I thought once we got through 122, we'd be off to the races. Now the problem, of course, is that 122, 125 level. If you want to draw a horizontal line, those have been tops now a couple different times, so that's been problematic. Now here we are at the 200-day moving average. The naysayer will say, well, if the consumer's strapped and, the problems they're having at the parks going to manifest themselves in the stock, Netflix continues to be a dominant force. But if Netflix is showing some signs of slowdown, it's going to impact Disney as well. So I think there are a lot of people probably going in this bearish Disney. I am not. I think it holds here and bounces, but that's what makes markets, as they say.
Yeah, and I guess the last thing, I'm sitting there, watching football over the weekend, and I feel like every 3 commercials I saw a Disney ad for Disney resorts. Okay, and I'm saying to myself, look at what's going on in the world. The headline on the New York Times, the top story yesterday was that the Trump administration is they're basically making a case for the states not to fund SNAP. Okay, so just think about that. And maybe someone who's receiving SNAP is not the sort of customer that's going to a Disney park. But my point is that if you've been furloughed, from a government job, right? You've been fired or doged from a government job, or you are not getting your SNAP benefits. These are not consumer behaviors that are going to just kind of come right back, right? Like on the consumer discretionary fund. I also saw a commercial yesterday, from Lowe's, and they're flipping through, and this is a commercial talking about, it's going to be hard, the holiday season, that sort of thing. And they're talking about, so I think this is working its way into the consumer psyche a little bit, which is, really, really difficult. Just lastly, let's pull up Costco, because this is, again, I'm just trying to tie this all together here a little bit. This is one we've been hearing about, a trade down to a Walmart customer. Go to a 1-year chart really quickly. I mean, you can see how heavy this stock is, and we generally don't see this stock trade like this relative to the broad market, right? And now let's go back to a 5-year really quickly, and you start saying to yourself, man, like this, what is this stock action telling you about it?
Well, I think part of the problem is the valuation is starting to weigh on people's mind. I think it is telling you there is a weakness in the consumer that nobody seemingly is willing to talk about, that is starting to manifest itself in names like Costco. Obviously, we talked about Home Depot earlier. I don't want to say Walmart yet, because Walmart's hanging in there. But the flip side of that coin is, when TJX is doing what it's doing, it suggests that people are trading down. And the strength in TJX, the continued strength to me is just sort of part and parcel and galvanization, or I guess putting a stamp on the things you just talked about. I mean, the fact that the consumer is weak lends itself to names like TJX, and obviously is showing some signs of weakness in names where valuations become a bit of a problem.
Yeah, and then on the flip side, as far as valuation, which is not a problem, look at FedEx and UPS today. They do not trade well, and you could extend this narrative a little bit as we go, into the holiday season. Now, obviously, FedEx has traded well since its report, but the price action today, and then go to UPS, which is down nearly 4%, and it looks like it wants to kind of fill in that gap. So again, just trying to make a little bit of a mosaic, but I guess to kind of bring this thing to bookend the whole conversation. And going back to the concentration in the market, I mean, we see what's doing the heavy lifting today, and there's really not too many other sectors that you can point to and say, oh, well, it's broadening out. The breadth is really good, that sort of thing. So I don't believe it's different this time. You don't believe it's different this time. Carter's work might suggest that it's not different this time. And you know what? And we're not talking about 10, 15, 20%. We're talking about just give us one of those 5, ish sort of things. Let's put a little fear into the market. You know what I mean? And I think that was what was going on, last week a little bit, but it seemed like in every other day. And it seems like we're, kind of one step back, almost 2 steps forward. And I think if we flip flop that to 1 step forward, 2 steps back, that might be the sort of thing that will kind of take some of the froth out of the market near term, guy.
Keep an eye on the rest of the day. I know the Dow is not important, but the S&P is starting to show some little signs of weakness here midday-ish. You mentioned Russell. Keep an eye on that and see if the VIX fights back to unchanged on the day as well. That's something I'm watching too.
All right, man. Thanks to Carter Braxton Worth for being here with us today. You and I will both be on the CNBC's Fast Money at 5 o'clock. You will be recording with Liz Thomas. That will drop in the Risk Reversal podcast tomorrow. Maybe you guys will kind of give us a little 411 on what you expect from all these
Fed speak.
Fed. Yeah, that's like so in her wheelhouse, isn't it, guy?
Totally, and I love talking to him about it. We'll also talk about the Packers-Eagles game tonight.
Yeah.
And tomorrow you'll know the outcome of, but we won't when we talk.
No, you won't. Well, that's great. We've covered a lot of ground here today. We'll see you tomorrow at 11 a.m. for the market call. Check out Guy and Liz and the Risk Reversal podcast feed. Thanks everyone for being here.
This episode of Market Call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. Try it at fidelity.com/Trader Plus. Fidelity Investments and Market Call are not affiliated. Views, opinions, products, services, and strategies discussed are not endorsed or promoted by Fidelity Investments. Fidelity Brokerage Services, LLC, member NYSE, SIPC.